Like, I literally tell people, unless my mom can use it, you've probably built the wrong thing for mass adoption.
Welcome to Block by Block, where we dive into topics at the intersection of crypto, tech, and society. I'm your host, Denelle Dixon, CEO and Executive Director of the Stellar Development Foundation. Join me as I sit down with a different expert each episode for a conversation on how crypto and blockchain are shaping their corner of the world. Welcome back to Block by Block. Today, I'm sitting with Austin Campbell. He's the founder of Zero Knowledge Consulting, and he helps institutions really think through stablecoin design, regulation, and crypto infrastructure. He also teaches digital assets at NYU Stern. Before this, he led portfolio management at Paxos, and he worked in traditional finance at Stoneridge, JP Morgan, and Citi. He's a wealth of knowledge. So together, we're going to get into how value actually moves. So we're going to talk about velocity, real-world assets, openness, and privacy on public chains, and why openness matters, and what all of this means for 2026. Well, Austin, it's so wonderful to have you here.
I'm very happy to be here for this one.
I would love for you to introduce yourself to the audience. There's so many ways I could introduce you, but you could do it better.
I'm Austin. I was once described by a friend of mine on another podcast as, exact quote, a grouchy fixed income person. And I think there's a lot packed in there, which is to say, I started my career right after the great financial crisis in finance proper. I'd done a few small things before that. And it was my job to run around to all the buildings that had burned down and figure out if there was anything we could save and if we could salvage any value. And if not, what are we building as a new building? And so I ended up, like it or not, with a pretty deep understanding of the inner workings and plumbing of the financial system doing a lot of this work. And that sort of led to a chain of events because I have this problem where when people ask me to look at gnarly stuff, I typically just say yes, of getting into crypto from a very unusual vector, which is actually part of why Stellar's been so interesting to me, which is I didn't get in through Bitcoin. I didn't get in through speculation. I got in because I was trying to solve the problem of instant settlement. So if there was a replay of 2008, I could trade with Lehman Brothers Friday afternoon. Right?
Change the world.
Exactly. And so it gives you a very different sort of grouchy perspective on things. And that's led me to a lot of advisory work. I used to run stablecoins at Paxos. I now teach at NYU Stern, but all of it's from this vector of how do we take broken things and fix them.
Well, that's great. And I think all of the background is why we're having you here today, because we can talk across so many different topics. So last year, backwards to 2024, you made a lot of predictions about what 2025 was going to look like, especially around stablecoins and them finally making it to mainstream. And I think 2025 backed a ton of that up. We saw a lot of financial institutions and payment platforms really adopting and increasing that institutional awareness and usage of it. Now, here we are in 2025, at the end of 2025. And the big question is, will stablecoins work in 2026?
So I think to unpack that a little bit for the casual person, especially if you're an American, because the value of them are not going to be nearly as apparent to you living in the American financial system, stablecoins essentially create what I'm going to call a third form of money, right? In the current system, we've got physical money. That's easy to understand. It's dollar bills. You can have them in your pocket. You can hand them to people. They exist. That's fine. We also have bank deposits as one of the main methods where we move things around, or if not a bank deposit, other forms of what I'll call stored value products, right? Like, for instance, a PayPal balance.
Yeah, mobile money.
Right,
yeah.
Exactly. And the key thing to understand there is, even if you're not experiencing the grit, when I make a payment where, say that I bank with Chase and you bank with Bank of America, and I make a payment and they've got to send money, net of the liquidity they're usually holding, if you get beyond that, and by the way, that's idle money, which sucks. And then if you get beyond that, it's literally the process is Chase sells things, gets cash, sends the cash to Bank of America, who then buys things, which is mental if you think about it. Stablecoins allow you to separate the act of investment from the act of transfer. So I can have a pool of money that remains invested the whole time. And it's more like, imagine a world where literally everybody banked with Chase and they're just moving tags around when money moves between those two people. So not only do I think they will work, I think they work in novel ways that are opening up opportunities that people do not fully understand. Like the internet in the 1990s, nobody looked at that and said, aha, like TikTok.
Yeah, that's true. So one of the things that we hear a lot in our industry is a lot about volume. And at Stellar, we focus a lot on velocity. And that doesn't just mean speed. A lot of people think it just means speed. We like the idea of money moving and changing hands quickly and getting into different systems and different companies and different nations, because that demonstrates usage. So you teach at the New York University Stern School of Business. What do you tell, or how do you talk to your students about velocity and the importance of velocity?
Yeah, as you think about a financial system, it's important to understand not just the stock of funds, but also the rate at which they move around, right? And that's because you need that for economic activity. So theoretically, let's say we have a system where people want to spend $1,000 a day, but each dollar can only move once. You need $1,000 to make that work. If each dollar can move twice, you need 500. If each dollar can move 10 times, so on and so forth, right? If it can move 1,000 times, you could run that whole thing with $1 theoretically, because it's just round tripping itself. And what it means is that the higher the velocity of money, the less trapped capital or like idle capital that you need in a lot of systems. That's part one, which I think is quite important. Part two is that velocity and the capacity for velocity are two different things, because one of the other important parts is that transaction demand are not monolithic, right? People have different transaction preferences. And so if I have a system where we net settle once a day and somebody wants to do something faster, they're stuck.
Right.
But if I have a system that's potentially instantaneous, often I can also do things more slowly. So put differently, you can drive a fast car slow, but you can't drive a slow car fast, right? And so the capacity for velocity is equally important to the actual velocity, because it just opens up new use cases.
And it creates more flexibility, definitely for the what's built on top of these assets and how these assets are leveraged. So this idea of stuck capital, it's really powerful. And I want to talk about where that's actually happening right now. So we're seeing a flood of tokenized treasuries and credit and real estate. And so from your perspective, what separates projects that increase circulation and access from ones that are just digitizing something that remains closed?
Yeah, I mean, I guess the core question we're really asking here, back to the start of this whole thing, is what's the problem we're trying to solve here? And so I'm like on the record as having been somewhat skeptical of a lot of things like tokenizing private credit just for the sake of like moving it from one ledger to another ledger.
Holding it in custodying the assets, but not using it as like natively issuing on chain.
And not being able to like trade it, because what have we done, right? Like that achieves functionally very little. Maybe your ledger is slightly better, but it's certainly not 10x better. So I would tell people, as you look at these projects, fundamentally what is important is either opening up new and better ways to transact, which can be very important. A good example of that is stablecoins, right? Like now we've got dollar payments that, as I described earlier, kind of change functionally what's going on with money, but also change the vectors through which you can exchange money. Or if you want to go all the way to the other end of the spectrum, some things I'm optimistic about on a forward basis, even though the market has yet to catch up with me, is like tokenizing interest rate derivatives.
Oh, interesting.
And the reason for that is in the current system, you have giant gappy behavior. If I'm a clearinghouse in the United States, I operate on New York banking hours. And that means if there's a giant move in rates markets at 2 a.m., I'm going to wake up and margin call everybody, and then they're going to have to backfill that. If I had, a 24/7 instant ledger that everybody could see so they could trust what was going on as it was occurring, you could do 24/7 automatic margining. And that's actually doing something different.
Yeah.
That's not just copying your ledger and putting it somewhere else and having it behave exactly the same way. So I guess the test I would have for everybody is, if you're looking at tokenized assets and people building things, ask, what is the problem you're solving where there are new capabilities by doing this? If you find those, you found what matters.
Well, again, okay, and taking that then, lots of RWAs out there.
Yes.
Real world assets, RWAs. That's how we call it in our world. In your opinion, what's one RWA initiative from this year that genuinely has changed how value flows? And second, what is one that maybe sounded cool, but probably won't be around for 12 months?
Okay, so changing how value flows is an interesting concept here. I'm going to give actually maybe more than one example. A simple one I can think of is Etherfuse. So they have non-US dollar government debt.
Yeah.
So like Mexico, Brazil, Colombia, right? And what they're doing is making that was a very local, like, do I have a Mexican peso bank account type situation into something that's distributable to more people.
Right.
I think that's actually a much more interesting form than people understand.
Yeah, because also there, historically, it might have been folks within the country that were leveraging that, but now everyone can.
Correct. Another one, I'm giving people a sneak peek of something that maybe will also be coming in Q1 of next year, is if you haven't been paying any attention, PayPal's stablecoin has gone from barely existing to almost 4 billion outstanding. And they are in the process of sequentially turning on rails globally so that people can mint, burn, and pay with PYUSD. Mm-hmm. What this does is it completely replaces a broken correspondent banking system for small to medium-sized transfers. Because now, no matter where in the world you are, if you have a wallet and I have a wallet, especially if we have PayPal on each side, but even if not, you're sending value back and forth and then being able to send it onwards to other people who can use it in the normal financial system. It actually acts as a true bridge. And so implementations like that are very exciting to me. If you want an implementation that's not
terrible. Just to jump in, and what PayPal cares about, of course, you have to care a little bit about volume if you're them, but they actually do care about velocity, which is very interesting. So go ahead. Now the one where it sounded good, but...
To me, a lot of the tokenization efforts around relatively available U.S. securities that themselves are now not super tradable on chain have been less than appealing. And those come in two forms. So let's start with the good one, right, where it's actually becoming something super interesting. So some people were solving just for regulatory problems. So like, let's take Franklin Templeton. Mm-hmm. When they originally created Benji, it wasn't transferable. But that's not because Franklin Templeton didn't want it to be transferable. That's because Gary Gensler didn't want it to be transferable. And as they melt that ice cube, it's becoming something more like a stable coin. So there is a transformation vector. But if all you do is tokenize a money market fund and it just sits there, again, like we can use a normal ledger for that. There's not much that's exciting going on here. I think another one that I've been very skeptical of is a lot of the private credit funds. So like I'll point to Goldfinch as one that's been like not successful, to be blunt. And there it's because the core problem of quality underwriting and emerging market loans has nothing to do with the blockchain. Yeah. That is like an underwriter and risk management problem. Right. And do you do a good job of that or not has nothing to do with the ledger you recorded things on. So either you're going to lose the principal or not. And in that case, largely they did. And so I think those are the ones I'm warning people to be skeptical of. Like, look at it and ask yourself, what problem is this solving that the blockchain helps with?
Interestingly, I mean, if you can get around the Gary Gensler, the issue about not wanting to transfer it to people who they hadn't KYC'd first, the one thing that I love about the U.S. Treasury-backed assets is the access outside the U.S.
Yes.
And so that gets me to the access part and who gets to have access. And that brings us right into this like bigger design question about what should be open and what should be controlled.
Well, let's start by saying that the current system is far from perfect and kind of exists because a series of compromises that were made at the time that were not representative of the world we now live in, right? Like, so I wrote a paper on this in securities markets with V, who's a former SEC staff attorney. She's great. She did a lot of the work on that paper, actually. So give her more of the credit. But there we're talking about the fact that current equity market structure was largely created in the 1970s in response to the paperwork crisis and did not contemplate the internet, much less blockchains. And that, interestingly, a more decentralized, interoperable system was understood at the time to be better. They just did not have the technological capability to build it, so they ended up with a centralized clearing agency. Okay, you compromise at the time, but that's not a statement that we shouldn't do it right now. So where does this bring us with openness? Well, the current financial system kind of operates as follows, which is to say, hey, inside this thing, it's kind of dark. We can't always see what's going on. Every bank, when they're looking at risk, is kind of staring at their own 2 feet with a flashlight. So we're going to try to have a very high wall for who can get into this system in the first place. And then we don't totally know what's going on inside of it. But the reality is, if you look at a lot of heuristics, there's a lot of bad stuff and we're just not finding it. Contrast that with a blockchain. I would tell you a blockchain that has some degree of potential permissions or controls for assets, which Stellar is a good example of that, functions more like a public park. That is to say, the default is that you can go in. You can walk around, you can look at the trees, you can hang out by the waterfall. But if you're causing a huge problem, you might get kicked out. The police might show up and escort you out of the space. And so flipping that default assumption from no to yes, and then it's no until you give us your papers or yes until we can tell you're a bad person, creates a very different set of options because there are, again, as an American, you probably don't have to deal with this. Yep. But there are a lot of places in the world where just getting legal ID is a problem because the system is broken and inefficient. You've got to bribe people. And even when you get it, they'll take it away from you. It's a mess. And so a system where we say to people, hey, we can observe your activity, even if you're using a pseudonym on chain. We can see you're not transacting with Hamas because we've gotten quite good actually at observing blockchains. And so the default is, hey, if you've got $500 of stablecoins, go buy a sandwich. That's actually a significantly better system with less overhead and more access.
Well, I mean, and this is one of the things I constantly have been talking about over the last, 6 months is this idea of what I've called the permissionless premium. And it's the idea that open networks and they create economic value and innovation because of the fact that there's access and there's interoperability. That's the idea of an open network. Closed systems, they protect and control and manage. But what you just said is the idea of the open system until you do something wrong makes a lot of sense.
I think there's another layer to it as well, though, right? Because that's open on user terms. But now let's also talk about the other side of that sandwich, which is open on builder terms. Right. So this is an example I use in my class at Stern to talk about sort of the power of blockchains and decentralized financial systems is if you come up with a great idea for a business and you think it will actually generate significant economic value in the traditional sense, making the world better for people. But the requirement is you've got to somehow build it and integrate on top of the Chase app in the Google Play Store. It's just not going to happen, right? To do that, you've got to go to Chase and explain that and get their permission. And then they're just going to steal your idea, right? Or charge you some exorbitant fee to work with you, or being realistic about bags, take 5 years and not integrate it successfully anyways. A blockchain, by behaving like money Legos, allows people to just start building things. You can just grab Legos out of the box and start building. And so if there are PayPal's stablecoin and a borrow lend protocol and AMMs, you could start stitching together financial applications to do something like automated trade settlement that just didn't exist before. And you don't need explicit permission to do it. You kind of have to be vetoed. And that's very powerful for innovation.
Yeah. I mean, I think that part of it is so important. I have said time and time again that for open systems, though, you need to demonstrate that the product, the ultimate product, whatever that product is on the open system, is better. And it can be better because of fees, the lower fees. It can be better because of interoperability. It can be better because of ease of movement. But it can't just be that the system is as good as. Yeah. Because you have the Chases of the world, because you have the vertical integration that's happening in blockchain right now, and they're going to continually push to make it so that they're heard and that you get in and it could be easy. You get into Coinbase and you go play on Base and it's easy. But the idea of this open, permissionless network that allows for those things you just said is a really important piece of it. Well, when I look back at my early days in the internet, infrastructure, HTTP, SMTP, TCP/IP, all of those things won. But I sometimes question, how do we make sure that openness wins with an environment where you see so much vertical integration? What are your thoughts?
So one is, I would tell you, those things won without people knowing they won, which is very important. Everything you just said, if we got my mother in here, she doesn't know what any of those things are. And by the way, my mother is not dumb. This woman's like a nurse who ran UCSD's bone marrow transplant clinic. She's very smart, but she's not a technologist. Yep. And so one thing that I think was a big lesson of the internet and Web 2 that crypto and blockchain like communities have yet to learn, is that UI UX is so important.
So important.
And normal people being able to use this thing will be the unlock. Like I literally tell people, unless my mom can use it, you've probably built the wrong thing for mass adoption. And so I think part of the mistake that's being made here, which by the way, in an echo of the internet, is the mistake a lot of people were making with the internet in the 90s, was putting the complicated technology front and center or assuming that people would just adopt that. And the reality is most people are not. Like, it's funny to think about it, especially in light of history and how it did, after the fact. But like AOL was actually a huge innovation at the time because it moved from having to know how to run a BBS really to meaningfully engage with the internet to I just put this CD in a thing. Right. And that is a huge upgrade. So the thing I would say that vertical integration has done really well in the financial system is make it easy for users to do things. Now, maybe the fees are egregious behind that and the offerings are not great. But one of the fundamental learnings is if you can't face the customer and make it easy, you're not going to win.
For sure. And that gets back to the whole thing. It has to be better.
Yes.
And one of the things when I was at Mozilla, we were building Firefox OS, which was based on HTTP, and it was a mobile system that was as good as. But because of vertical integration, when you think about Android and everything they had to offer there, we couldn't compete because they had a great Play Store. They had everything in there. And it was a lesson for me that I've carried over here is that you have to think about your user, whether it be an SME, whether it be a big business, whether it be a consumer, and make it so the user doesn't ever have to know. And it was funny because they used to say, well, everybody's going to build on this because we're building in HTML. Like we're building and everybody wants to build there. I was like, no. Yeah. Everybody knows how to build there if they're a developer, but they don't necessarily want to because they want what's easy. So it's the same thing here. And I think that this moment is something that we need to really focus on by proving the value of the open system through UX, through product integrations, through the ability for everybody to be able to access it without having to know that this is what you're accessing.
Yeah, the killer app in crypto in many ways for the average two-legged human being will be, can I just pull a thing open on my phone and either scan a QR code or click a button, and I don't have to think about the fact that a blockchain is in the background. The money just moves instantly and cheaply either to me or from me, and we're done. Just
another rail.
Yes.
Just another rail. Any examples from the past year where you have seen that these open rails clearly have beat a closed system for settlement, time, access, whatever?
Yeah, I mean, okay, so let's talk about some concrete examples that have gotten very big. One is US dollar stablecoin access as a tool for escaping inflation. That has been a huge thing in emerging markets over the past year. And we've seen, look, this started in 2022, but really last year it accelerated dramatically to the point that you now have countries having meltdowns at the governmental level because they can no longer expropriate their local people effectively because they're getting into the US dollar. There are some gray market estimates that double-digit percentages of economic activity in some African or Latin American countries may be done in US dollar stablecoins. That is giant because if you were the average citizen in, say, Venezuela, right, where if you saved your money in the local currency every year, you just consecutively basically get totally wiped out. And now you can get out of that into US dollars. That is life-changing. So one, again, US people don't see that. But two, let's talk about something I think maybe a little bit more interesting in the United States, which is forthcoming on that front. If you have a bank account in the United States right now, here's a challenge for you if you're listening to this podcast. Go and look at what the interest rate you get paid is for the economic risk you are taking. By which I mean if the bank fails, in a good scenario, your money gets locked up for a while and then you get it back. And in a bad scenario, aka you're over the FDIC limit, maybe you get it back, maybe you don't. And they're probably paying you zero. Right now, passing the Genius Act in the United States, if you want to talk about a structural upgrade, you will soon have the ability to get paid rewards in some form for a non-zero amount on what is essentially a blast-proof bankruptcy remote box filled with T-bills. Right? This is the equivalent of taking a government money market fund and using it to pay for everything.
Right.
And by the way, we already have that in the system. It's just clunky. Fidelity's actually got a cool cash management account that approximates this. But if you look at the back end of that, It's a Frankenstein. Yep. And this just compresses it all to one point. So I think over the next, call it 5 years, the group of people who are most harmed by U.S. banking structure currently, which is small to medium businesses, are going to find a massive upgrade to the financial system on that basis.
Yeah, I agree with that. I think that's absolutely true. But we can't talk about openness until we talk about privacy. Because what I've heard, and I'm sure you've heard this time and time again, is financial institutions are not going to use blockchain until you've solved the privacy challenge. So it's only going to be legitimate then. So first, what is privacy when it comes to this financial infrastructure that we're talking about?
I might argue that most people saying that on the traditional financial side have not yet paused to define privacy, and they probably should. Because if you think anything that you've given to a bank is private, you're crazy, right? Not just because of the third-party doctrine, which, by the way, allows the government to go to the bank and take all your info from them, but also because virtually anything from a bank is already on the dark web. Like, I'll just name some names here. Any of Chase, Bank of America, Citibank, Wells Fargo, PNC, Capital One, I could go down the list, have live employee credentials for sale on the dark web right now, right? And I'm very confident in that. And what it means is all of our stuff has been hacked. All of it is more exposed than we think. And what these companies are really worried about is protecting their competitive advantage. Exactly. They don't want competitors seeing what they're doing and coming after their customers or trade flows. So what do we actually mean by privacy is just people being able to conduct business without essentially getting front run or sniped by competitors and doing it in a way where you're not unduly leaking information everywhere. And the answer to that one, to be totally honest, is just a functional implementation question, right? Like, there are ways to do this already in traditional markets. Like, everybody freaks out about Tornado Cash and mixers, but that's called a dark pool, and we use them in equities.
Yeah, we do batch all the time too, like all the time.
Literally right now. Like, I've been involved with this in the past, like trading at banks. And so, I think there are these functional misunderstandings that all of these things are possible, and it's just a design question, right? There are encrypted blockchains. We can run mixers. You could have a dark pool. You can do batching. You could do wallet rotation and segmentation. You could do token burns and bits. Like, there are so many options for solving these problems. And I actually think what you've hit on here, which is really important, is just an education and implementation problem. Like, this is people not understanding, not having the capabilities.
Yeah. And I think when it comes to the consumer, privacy is different. You don't necessarily want someone to see everything that you're paying for. There are ways to protect the consumer side. And this is one of the things I say all the time, is that you can't take privacy that we have right now in the off-chain world and just like move it over to the chain. It completely obliterates the value of the chain. But there are components that we need to be mindful of. Path payments. There's a lot of things that allow for banks to protect their interest, but also for consumers to get their interests protected. So do you think that there's anything actually standing in the way of usable privacy on chain in 2026?
Banking regulators. And what I mean by that, so I want to be clear, I've got friends at like the Fed and the OCC and the FDIC, but one of the problems that banking regulators specifically in the United States have is they are understaffed and underpaid. And so a lot of times they're very behind the curve on technology. I really do think there is a need for significantly better, just straight up understanding at the regulators and then at a lot of the financial institutions themselves about how these things work. Because like, I'll name two names I used to work for, JP Morgan and Citi. So I've worked at both of those places. And I would imagine if you go there right now and look in their risk groups and ask somebody there, anybody in the bank, raise your hand. What are the absolute best practices for anti-financial crime and blockchain? Not only do they not know, they don't realize that doing it well actually gets them better results than what they are currently doing internally. Like, without saying who it was, one of the big banks recently spoke with a company that, to be blunt, runs this program for like DARPA and the Department of Defense and is finding absolutely amazing stuff. And basically couldn't understand it and was like, oh, we do all of that. Well, at the same time, they knew all kinds of things about the bank that the bank didn't know about itself. This is an education problem. So I really do think we need to get up those stairs to change this.
Yeah, I think if we focused around privacy for the consumer it actually solves 90% of the privacy issues that we actually have to think through.
Well, I also want to invert that, right? Which it doesn't just solve it, it improves it.
Yeah.
That is to say, there is a lot of fraud in the traditional financial system. And a good example of that would be if you get scammed and money leaves your account with a real-time payment and then goes 2 hops forward, it's just gone. This is why banks make it so hard to send wires, right? Is once the money goes,
Hard
it
or
goes.
Impossible at this point because of all the fraud. But yes.
Fair point. I have successfully sent a wire in the past year. So it's not always impossible, but it can be.
Yeah.
But on the other hand, if that's a US dollar stablecoin and we can see that path on the chain, we can take it back. Right. And so there are literally new capabilities that don't exist in the current system that not just solve it, but make it better. And that's why it's so important not to copy paste. It would be like taking the rules for horses and putting them onto automobiles.
Absolutely. I think that is the problem that I think is that the regulatory environment doesn't allow for a lot of, like, they get so concerned about new tech that they don't allow for that. So it's our job as an industry to really educate. And I think that we're doing a better job than we've done in the early days of the web, but I think we still have work to do. There must be something in the traditional financial infrastructure of today that we can't lose as we move to blockchain. What is that thing?
So I think there's more than one, and it comes back to what problem do these things solve? So I'll point at a couple, and in fact, in some cases, by not thinking about them, blockchains have had gigantic failures. So one good example is underwriting, right? There's nothing about a blockchain that does underwriting, right? Like understanding risk and probabilities is a whole discipline in and of itself. And while finance has had many notable failures in this space, they've also had some giant successes. Again, I worked at JP Morgan, and for every criticism that one could level at that institution, I will point out they bailed out the US itself twice, right? And continue to basically be the best risk managed bank in the world and have held up the financial system. So maybe some credit where credit is due, right? So that's one angle, is just like the basic underwriting capabilities. Number two, from the traditional financial system that I think is really important, is there are a lot of things that happen in trading systems around like circuit breakers, like trading methods, observation, that are very important to make markets work in a normal way. Because anybody who thinks no rules is the correct answer needs to go study the pre-1933 experience in the United States and what was happening there. There are a lot of structural upgrades that matter there. Like, here's a good example. Mango Markets is a famous hack that happened in the crypto ecosystem. Right. And fundamentally, the way that worked is there was a guy named Avi who realized, I could take this one token that's relatively small and thinly traded and pump the volume of it up way up and then borrow a huge amount of money against that and then let it collapse. Well, that's only possible if you never thought about a repo lending framework where you don't lend against immediate spot price. Like, had Mango Markets just used like a 48-hour trailing average of a token price, none of this would have happened. And by the way, any repo desk on the street could have told you not to do that. Right. So there are a lot of things around trading methods, trading systems, surveillance of systems, like all of that matters. The last one that's really important is consumer protection. I want to go back to my mother on that one. Again, she was a nurse who was running a place that cured people with cancer and working like 60 hours a week. You can't tell her, stop doing that, do your own research, figure out all these things for yourself. I know those kids have like leukemia, but let them die. You need to understand self-custody. That's insane. It is a refutation of the value of specialization of labor. So until we get consumer protection for, call it retail users, correct, I think they're just not going to adopt these systems because they don't have the time to become experts.
Yeah. We have to make it simple enough for them. One of the things we learned in the early days of the web on privacy, you needed to give them notice and the opportunity to understand. And if you did that across a lot of vectors here, it actually helps to solve that. Okay, last question. Stablecoin was the term that dominated 2025.
Yes.
You heard that everywhere. What is the word that will dominate 2026?
I think we're moving towards settlement, right? Like, stable coins are one aspect of that, but like, why is it important to have a stable coin? Well, stable coins function as money. And, to paraphrase The Simpsons, Homer, money can be exchanged for goods and services, right? So now that you have the money object, we've got goods and services that you can trade for it. And that brings you to the act of settlement. Because one of the core problems in like very basic economics 101 is who goes first in an exchange, right? Because let me pose you two things, right? I live in Brooklyn. I've got a coffee shop down the street. I really like them. I go to the coffee shop and I say, hey, I want just like a drip coffee with whole milk. And they make the coffee to me, for me, they hand it to me and then I pay. Okay. Here's the problem. They've made the coffee. They've handed it to me. If I go and I've got this bag of pennies, they're kind of stuck either not getting paid or accepting the pennies. If they do it the other way around, I have to pay and hope they're going to give me the coffee, right? But what a blockchain does is it literally allows for the simultaneous exchange of financial goods. You could create a smart contract container, right? And one side could deliver like tokenized gold. The other side can deliver stablecoins, and they only clear when both are in there. You actually solve that problem. And settlement is very under-discussed and is like a boring guts type thing, but actually one of the biggest upgrades that blockchains bring.
No, I love it. I do love the idea of you walking in with a bag of pennies, because you know how they're not making pennies anymore.
I know, right?
So they might become a priceless commodity.
Or a somewhat higher priced commodity. There you go. You heard it here first. Long pennies.
Thank you so much for joining us. I really appreciate you.
I appreciate you having me. This was really fun.
Awesome. Thanks so much for tuning in to this episode of Block by Block. Austin left us with a lot to think about. Especially for me, what I took away was this idea of the blockchain as having its Lego building blocks. And when you can build different things on this open infrastructure and you never need to get permission, and the importance of that. It also helped us to connect the value and the movement of value, why openness is important, and the future of privacy in digital finance. So we'll see you in the new year. Happy holidays.